Hello and welcome to the Global View. Let's look at ways to make money beyond the ASX listed universe. I'm Nadine Blaney. Just to set the scene, it was a pretty quiet night for economic data. However, we did see the Fed's loan survey released, Fed Loan Officer Survey, showing further tightening in lending standards for mortgages and an acceleration in tightening for commercial real estate loans. So there goes the impact and the lagging impact of all the rate increases that we've had. But we're going to turn now to China. Timely as Australian Prime Minister Anthony Albanese meets with his counterpart Xi Jinping, marking the first official visit to Beijing by an Australian leader in 7 years. It comes as both business and consumer confidence in China remains subdued, despite some recent green shoots in economic data. For more on the outlook and fresh back from a trip to China, Zerlina Zheng from Credit Sites joins me now. Zerlina, hi, welcome, thank you. Did you get a lot of clarity as far as being there on the ground as to the true picture of economic growth in China?
Thanks for having me here. So actually, despite the recovery of business and consumer data on the economic activity front, we have not seen much recovery in terms of on-the-ground business sentiment or consumer sentiment. I think one reason is the households are still carrying out a lot of precautionary savings due to both a negative wealth effect, which is the declining housing value, and the second reason is the declining employment rate as well as their salaries. On the ground, it seems like the property sector has also not staged any visible recovery either. There has been some upgrade-related home demand in first-tier cities, but in the lower-tier cities, especially in the small districts and small cities, it seems the home buyer sentiment is still very muted. Overall, it feels like the policymakers are more comfortable with a contracting property sector over the next few years because of the declining urbanization rate as well as the changing demographics in China. And on the on the business sentiment front, those related to the property value chain, I would say the willingness to invest is not very high, especially those commodity related ones such as the steel sector, the other non-ferrous metals and mining, cement, as well as some of the utility sector related to industrial production.
Okay, so having said that, when you are speaking to investors in China, if we just look at the property sector, are they still very wary of Chinese property and credit in property as well?
Yeah, I would say the sentiment has turned even a bit worse after our last conversation with them in September, especially given many large property developers, or which were once perceived as higher quality, such as Country Garden, has defaulted on their dollar bonds and some of the onshore bonds. Some of the onshore investors, they were talking about chasing the offshore dollar bond because they are relatively cheaper than the onshore ones, but this kind of conversation has kind of died off in this conversation with them this time around. Overall, the onshore investors think it's almost like a consensus that China is going to see a multi-year property downturn. Most of the investors think that most of the privately owned developers will kind of die off or default on their property bond in the end. The state-linked ones will in the end be the survivors and thriving in the China property market. So I would say overall the sentiment is still relatively muted.
Okay, how about local government debt? Are there any landmines there waiting to blow up?
Actually, this sentiment has turned very positive in the past few months for a few reasons. The first one is really the rhetoric from the central and local government has turned very friendly towards the sector. The local government has been allowed to take out special purpose local government bonds, and they use the proceeds to swap up some of the high cost local government financing vehicle debt. Then just recently, the central government pushed out 1 trillion RMB of special central government debt, and these proceeds will be transferred to the local government to support their fiscal conditions. So overall, we are seeing a much better funding condition for the local government financing vehicles. The onshore investors are really chasing these bonds issued by the local government financing vehicles. For some of the weak regions and weak entities, we are seeing the bond yields coming down all the way from 20% at the start of the year now to high single digit.
All right, and just very quickly, Zerlina, are you still positive on Chinese tech? What in particular?
I think we are still quite positive on China tech dollar bonds. This is the segment we really like within the China credit space. We are so far not seeing that much credit impact in terms of the broadened US chip ban, because the core business of most of the tech companies we cover, such as e-commerce, online advertising, gaming, they are not so much using the very advanced chip yet. For some of the hardware players, such as Lenovo, their business is more geographically diversified. So over the near term, not so much of credit impacts, but of course, if we're looking at the medium to long term, this is definitely going to drag on China's technology process. So we are monitoring the situation for the medium to long term.
Well, Zerlina, thank you so much for joining us to give us your fresh from China insights. Appreciate it. Now, let's get to stock specifics. Let's go stateside. Let's talk about a company that I don't know much about, and hopefully you don't either, but you know who does? Andrew Brown from East 72, talking about Virtu Financial. So Andrew, hi, nice to see you again. Thanks for joining us. Why are we talking about Virtu Financial?
Yeah, Virtu's a pretty unique company in the US. It's the only listed US market maker. And market making is a term people don't like it, so they're called liquidity providers. It was IPO'd in 2015. It was going to IPO in 2014, but there was a spectacular chart in the S1 filing that showed that only lost money once in 1,235 days, and coincided with Michael Lewis's book about flash traders. So they listed in 2015 at $19 a share. They're still only $18 a share. They have paid some pretty generous dividends since then. The company's got a market value of about 2.9 billion US, and it's got $1.8 billion of debt, which all matures in 2029. It is a controlled company. It's controlled by Vinny Viola, who founded the firm, and also the CEO is the same as his co-founder, who's Doug Tifu, who also owns part of the Florida Panthers ice hockey team. What do these guys do? They basically make markets in stocks, and they effectively handle about 9% of the US equity volumes through their machines. If you look at the structure of the US equity markets, there are actually 16 exchanges in the US. There are 3 or 4 or 5 of them, each owned by the NYSE's holding company called ICE, the NASDAQ, and the CBOE. They're all listed companies, as you'd be aware. And then the other one who's a big player is Citadel, the major hedge fund, who is a market maker as well. And so behind them is Virtu. And they're the only real way to get exposure to market making in the listed company sphere. They make money by basically 2 things. One is volume, obviously, like anybody involved in the stock market. But secondly, they make money on spreads. And spreads do tend to correlate with volatility. So the higher the volatility, then the higher the spread between the bid and offer price. And that's where these guys can really, really make money.
So, Andrew, has this company reported already? Like, how's it traveling right now?
Yeah. It's sort of traveling modestly, Nadine, I think is the best way to put it. It reported its September quarter last week. The way most people try to look at this company, Nadine, is in what's called adjusted net trading income per day. So that's literally the amount of money they make from trading securities each day and doing some agency broking. And on average, since they listed, they've made about $6.5 million a day from trading. In the last quarter, they made about $4.7 million a day. So it's trading before their overhead costs. But the story here partly is just because they're going fairly modestly at the moment, stock price has been skewered down quite aggressively over the last 12 months. And it means there's a lot of embedded optionality in the stock. What I mean by that, if you go to the movies right now, you can obviously go see the movie Dumb Money, which is basically about the meme stock boom of the first quarter of 2021, and in particular GameStop. If you think about it, what happened then? There was a lot of volume. It was retail volume. So it's done through Robinhood and Interactive Brokers. And those guys basically get money from people like Virtue to pay for their order flow. So there was tons of retail volume and the spreads were huge. And so in that quarter, to give you an idea, Virtue made nearly $12 million a day of net trading income as opposed to the 4.7 they made in the previous quarter. The other time they made money that you just can't believe was obviously in March 2020, with the COVID panic, high volumes, massive spreads, and they made nearly $13 million a day on average in March 2020. But in the last week of March 2020, when things reached a hiatus, these guys were making $33 million a day of trading income.
Wow. Okay, so Andrew, just strategically, would you be waiting to buy? Would you buy now? And I understand it's quite tightly held. So is this a tough one to get into?
No, it's not a tough one to get into. Vinny Viola controls it. He owns about 64 million out of 160 million shares. I've actually bought some recently. It's one of the bigger holdings we have in the Dynasty Trust. Why do I say that? It's because the stock is really cheap. Even at these sort of lower levels of volatility, then on my numbers, the shares trade on basically a PE of about 9.2 times, making some adjustments to the numbers to add back capitalized software and get rid of amortization of intangibles. So they're pretty cheap even when they're only relatively modestly earning. The last year's been basically 2 okay quarters and 2 pretty lousy quarters. And if you just took 4 okay quarters, the PE's below 7. You get paid to wait. The company has a 5.3% dividend yield. Don't forget, if you're in Australia, you'll suffer withholding tax. But also the company's bought back 16% of its stock in the last 3 years. Now, to be frank, it's been a bit too aggressive at buying back stock at certain times. It's buying back stock in the low 30s, and the stock, as I say, is 18 at the moment. But they still have plenty of cash flow to keep buying stock back. And with management being such big owners of the company, then they're really happy to do that. So I'm happy to be involved right now, Nadine.
Wonderful. Andrew, that was interesting. Thank you, as always, for bringing us something that we don't speak of all the time. Look forward to the next one.
Absolutely.
Take care. Andrew Brown. He is from East 72. You can follow him on Twitter as well, and he's got some details on the fund up online as well. Okay, quick check on what we are expecting here locally. A bit of an ease at the open, of course, looming very large here is not just Melbourne Cup, but what we are focused on is the RBA decision. Will they, won't they? Well, the major banks expect they will hike by 25 basis point in the wake of some hawkish rhetoric, and of course, the most recent inflation read, the most recent retail sales read as well. So lots to talk about in the next hour. It's the open coming up.